Alert! The silver market is cracking wide open. But not in the way the headlines want you to think. This isn't just a price move, it's a global fracture. The old system, the paper illusion, is losing control. Margin hikes are failing. Inventories are vanishing. China is locking the exits. And now, even the premiums are signaling something irreversible. What's coming is not a correction. It's a repricing of trust itself. The silver market isn't just cracking. It's about to break the rules of the financial game itself. And if you don't understand what's happening behind the charts, you may already be too late. Stay with me, because what you're about to see could change the way you think about money forever. Welcome to CSC Alert, your front row seat to the truth behind the headlines. If you're over 50, I invite you to slow down, breathe in, and listen close. This isn't financial hype. It's a strategic warning. So, where are you watching from today? Let me know in the comments. And if you haven't yet, do what smart investors do. Hit that subscribe button like you're locking in physical silver at last month's price. Because what's coming isn't waiting for anyone. They had seen silver rise before. In 1980, it was the Hunt brothers. In 2011, it was panic over money printing. Both times, silver flew high and then crashed. But this time, something is different. And those who are paying attention can feel it. This isn't just another rally, it's a reset. Today's silver market is moving on structure, not speculation. And that changes everything. What once was a leveraged gamble has become a global scarcity issue. In simple terms, there isn't enough silver to meet the demand anymore. He had followed silver for over 2 decades. But this time, what he was seeing made him uneasy. The patterns didn't match past cycles. Something deeper was pushing the price upward. And it wasn't greed, it was need. For the 6th year in a row, global silver demand is greater than global silver supply. Mining output is struggling, recycling has flatlined. In industrial demand, it's exploding. Solar panels, electric vehicles, consumer electronics all rely on silver. Unlike gold, which is mostly stored, silver is consumed. Once used, it's gone. And the world is using more than ever before. But it's not just about demand rising, it's also about control tightening. A decade ago, most people assumed silver would always be available, just like oil or copper. But now, it's being treated very differently. Governments and corporations are quietly reclassifying silver as something far more important than just an industrial metal. It's being seen as strategic. The United States Geological Survey now includes silver on its list of critical resources. That has never happened before. And over in China, silver is no longer just a commodity. It's now treated as a controlled export, with only 44 licensed companies allowed to ship it abroad. In both East and West, something has changed. And it's not just in reports or policies, it's visible in the markets. He noticed something strange when checking silver prices. On the COMEX, the big futures exchange in New York, silver was trading around $73 per ounce. But in Dubai, physical coins were selling for over $100. That wasn't just a premium, that was a $27 gap. And this gap wasn't caused by fear, it was caused by reality. The physical market was saying one thing, the paper market was saying another, and the two were no longer aligned. To understand why, he looked back in time. In 1980, when silver hit nearly $50 per ounce, it was because the Hunt brothers tried to corner the futures market. They used debt, they used leverage. And when the rules changed, when COMEX forced liquidation, the price collapsed. In 2011, silver rose again on fear of money printing after the financial crisis. Investors rushed into ETFs, the price jumped, but once the panic cooled, demand fell. Vaults were still full, supply was still strong, but today, vaults are emptying. There is no panic. Just quiet, relentless drain. That's what makes this different. Today's rally is not driven by emotion. It's driven by math. There's a shortfall. It's been building for years. And now it's hitting the system at every level. Refiners, wholesalers, retail dealers, and governments. The shortage is real, and it's global. He also noticed another key shift. The East is leading. In the past, silver's price was set in New York or London. But now, Shanghai and Dubai are pulling it higher. In China, people are buying silver in bulk, 15-kilo bars, raw slabs, anything physical. They aren't waiting for Western approval. They're taking action. This is where the crack in the market begins. For decades, the paper price was the reference. But what happens when the paper system is no longer trusted? What happens when the people buying the metal start ignoring COMEX and buying from whoever actually holds it? The answer is simple. The real price starts to break away. And that's what's happening right now. He understood that this wasn't a temporary move. This was the start of something permanent, a structural divergence between paper claims and real metal. Silver had always been underestimated. But now the truth was becoming clear. Silver wasn't just a commodity anymore. It was collateral in a world of uncertainty. It was energy. It was technology. It was currency without a central bank. And unlike paper money or futures contracts, it couldn't be printed. He realized that the old rules didn't apply anymore. That's why so many people were confused. They were waiting for a pullback, waiting for the price to behave like it had in the past. But this wasn't the past. It was something else. This was the start of a new cycle, one driven by real-world shortages, global power shifts, and a breakdown in price discovery. The silver market wasn't just rising. It was cracking wide open. She had seen the headlines. Silver had jumped more than 6% in a single day, only to fall sharply the next. To most observers, it looked like another speculative surge, followed by the usual correction. But beneath the surface, something far more strategic was unfolding. This wasn't just volatility, it was engineered pressure. In the world of futures trading, margin is a quiet but powerful force. It controls who can stay in the game and who gets forced out. And lately, COMEX has been using that force more aggressively than ever. In recent weeks, COMEX raised the initial margin requirement on silver contracts. Again, it had already jumped from $20,000 to $25,000. Then it went to $38,500. That's a 62.5% increase in a short period of time, not because silver fundamentals had changed, but because leverage was being reset. To the average trader, this looked like a cautionary move, a way to reduce risk. But for those who understood market mechanics, it was something deeper. Margin hikes act like pressure valves. They shake out retail traders, especially those using borrowed money. A sudden increase in margin means many long holders must either add cash or liquidate. This creates forced selling, and that's exactly what's been happening. He watched the price fall sharply after the hike. But then just days later, physical coin premiums rose again. Vault inventories continued to decline. Dealers reported delays and shortages. This wasn't a real correction. It was a synthetic flush. He understood the game. These margin hikes didn't create more silver. They didn't solve the structural deficit. They simply changed who was allowed to participate in the market. And ironically, they also exposed something deeper. Even short sellers were now under pressure. In the past, those betting against silver could rely on easy access to metal, either through vaults or lease markets. But now they were having trouble sourcing even basic bar-sized silver near the future settlement price. This was new. Both sides, long and short, were feeling the squeeze, and that meant something was fundamentally wrong. She reviewed the data. Despite falling futures prices, ETF inventories weren't rising. In fact, some were shrinking. If the market was truly correcting, silver should have been flowing back into institutional vaults, but it wasn't. Instead, a quiet game of musical chairs was underway. Each futures contract represents 5,000 ounces of silver. But for every ounce in vaults, there are now hundreds of paper claims. The leverage ratio is broken, and that means the paper price is no longer an honest signal. This is where the system starts to crack. Margin increases are meant to protect the system. But in a market where physical metal is scarce, higher margin requirements don't restore balance. They widen the gap between futures prices and real-world supply. He remembered the 1980 crash. Back then, COMEX also changed the rules, moving to liquidation-only mode. The Hunt brothers, who had used heavy leverage, were wiped out. But back then, silver was available. Vaults still had supply. Inventories were strong. Today, inventories are thinning. The short positions are growing. And the margin hikes are no longer targeting speculators alone. They're suppressing price discovery itself. She pointed out another detail. Even after large margin increases, silver's price recovered quickly. This told her the underlying demand was still strong. Industrial buyers weren't selling, stackers weren't selling, and central banks. They weren't even participating publicly yet. That was the most important clue of all. The real players, those who understand the nature of physical scarcity, weren't reacting to COMEX. They were bypassing it entirely. Instead of paper contracts, they were buying kilobars in Asia. They were accumulating physical ounces in Dubai. They were making long-term strategic moves, quietly, patiently, and far away from the headlines. He called it the two-market system. One market runs on leverage, contracts, and price suppression. The other runs on ownership, delivery, and physical control. And the bridge between the two? That bridge is cracking. As margin hikes continue, short-term volatility will remain. Traders will be whipsawed. Retail participants will be flushed in and out, but the structural shortage of silver will not be solved by price suppression. Because price alone cannot create new ounces. This is the key that many still don't understand. She believed the next phase would be different. COMEX could continue raising margins, but at some point the market would stop responding. Volatility would no longer flush the system. And then a delivery crisis could emerge. Not because people want silver, but because they need it for products, for grids, for solar panels, for industrial use. And when paper price manipulation collides with real-world scarcity, something must give. That's what the margin hikes are hiding. Not stability, but fragility. The silver market isn't just reacting to speculation. It's trying to hold itself together. With every rule change, with every margin increase, the illusion is being stretched further. And soon, something may snap. Because when physical silver becomes unavailable at any price, the paper price will no longer matter. He had been tracking global silver flows for years, studying shipping data and refining statistics. But one line in a new government filing caught his attention, and it changed everything. China had quietly reclassified silver as a strategic commodity, not banned, not embargoed, just renamed. But in the world of trade policy, that one word meant everything. It meant silver was no longer just a raw material. It was now a tool of national power. This wasn't a theory. It was already in motion. Effective January 1st, 2026, China's Ministry of Commerce imposed new restrictions. Only 44 licensed companies could now export silver in any refined form. Every ton leaving the country now required state-level clearance. She understood the implications immediately. This wasn't about profit margins. It was about control. China has long dominated silver refining. It imports raw ore from across Asia, Africa, and Latin America, refines it at scale, and re-exports high-purity bars. But with this new policy, that flow could be interrupted at will. In effect, China had built a gate and now held the key. He remembered the 2010s, when rare earth elements were used as geopolitical leverage. China restricted rare earth exports to Japan after a territorial dispute. Prices spiked, supply chains froze, technology companies panicked. Now it was happening again, only this time with silver. She believed this move wasn't isolated. It came just weeks after a regime change in Venezuela, a key oil and mineral supplier in Latin America. The U.S. had reasserted control in the region, likely to secure energy and resource flows. China, in response, tightened its grip on what it controls best: critical processing and strategic export flow. Silver, it seemed, had entered the age of resource nationalism. He traced the global ripple effect. Refineries in Switzerland and Dubai were already reporting sourcing issues. Indian industrial buyers were struggling to get bar-sized silver delivered on time. Delivery timelines had quietly stretched from 2 weeks to 5 to 6 weeks in many cases. And most telling of all, premiums were rising, even as COMEX spot prices remained flat or fell. This wasn't about investor sentiment. It was about real-world availability. China's move exposed something many Western analysts had ignored: the supply chain itself. Most of the silver that reaches end users doesn't come from mines directly. It moves through complex refining hubs, many of which are in China. Without those flows, the global supply chain slows. And when the flow slows, price discovery begins to disconnect. That's exactly what was happening now. She pulled up the live data. Shanghai spot silver had diverged sharply from New York futures. At one point, the difference was over $7 per ounce. Arbitrage should have closed that gap, but it didn't, because there was nothing left to move. The physical market was isolating itself from the paper market. This wasn't just about economics anymore, it was about sovereignty. By classifying silver as strategic, China could do what financial regulators could not: slow the bleed, prevent strategic materials from flowing into the hands of competitors, especially during inflationary or wartime conditions. And while Western analysts debated ETF flows, China was quietly building an inventory buffer, a firewall against future instability. He knew what this meant. If China continues restricting exports, either directly or indirectly, then silver availability in the West will shrink. COMEX and LBMA will have to rely more on dwindling domestic sources and secondary recyclers, and that opens the door to even more volatility. Because when supply becomes political, price becomes unpredictable. She described it simply: it's not about banning silver, it's about choosing where it goes and where it doesn't. The U.S. has started to respond in kind. The Department of Defense and Department of Commerce recently announced plans for a $7.4 billion smelting facility in Tennessee in partnership with Korea Zinc. The stated goal: to reduce dependence on foreign-controlled refining capacity. But these responses take time, years, not weeks. Until then, the imbalance remains. And every month that passes, China accumulates more physical silver, while the West leans harder on paper derivatives. The consequences of this divergence are now visible in pricing patterns. In Shanghai, silver trades closer to real-world demand levels. In COMEX, it trades closer to synthetic expectations, margins, algorithms, and leverage. As a result, the credibility of Western pricing is eroding. Buyers in Asia are no longer waiting for New York to tell them what silver is worth. They're setting their own price. And if the West loses pricing power in silver, as it already has in oil benchmarks and some agricultural commodities, the implications are enormous. It means the entire structure of commodity-based collateral could begin to shift. He realized if silver becomes a policy weapon, like interest rates or tariffs, then any company or country relying on it without control of supply is now exposed. This is not a market issue. It's a strategic vulnerability. And that's what makes this crack in the system so dangerous, because once a commodity becomes a weapon, it's no longer governed by price alone, it's governed by intent. And China's intent is now clear. He looked at the numbers again, twice. The March 2026 COMEX silver contract had closed just under $73 per ounce. But in Dubai, one of the largest physical bullion hubs in the world, the cheapest 1 Oz coin was listed at nearly $100. That was a $27 spread, a divergence that simply should not exist in an efficient liquid global market. Yet there it was, clear, persistent, and growing. She called it what it was, a fracture, not a temporary premium, not a short-term dislocation, but a structural split between paper and physical pricing, a divorce between what traders believe silver is worth and what buyers are willing to pay to actually own it. And like most fractures, it had started quietly, small cracks in confidence, but now it was turning into something systemic. In New York and London, silver pricing still ran through futures and over-the-counter contracts. But increasingly, those numbers were being ignored by real-world participants. Industrial firms, high-net-worth buyers, and bullion dealers were no longer basing purchasing decisions purely on COMEX or LBMA spot rates. Instead, they were asking one question: can I get it? And at what premium? This was new. In the past, even during volatile markets, the physical silver price roughly tracked the futures market, plus a small fabrication and delivery premium. But now, those premiums had ballooned far beyond the norm. In some regions, coins and bars were selling at 30-40% above spot, even when demand wasn't visibly spiking. That kind of price action wasn't noise, it was a signal. It signaled the beginning of dual pricing systems, one for settlement, one for possession. He remembered how the gold market functioned in the 1960s under the London Gold Pool. Back then, central banks artificially suppressed the price of gold through coordinated sales, but as demand grew, the physical market broke free. That system collapsed in 1968. A new price discovery mechanism emerged, one based on reality, not coordination. He now wondered if silver was entering a similar phase. The signs were there: delivery delays, vault drain, export restrictions, premium surges, and most of all, regional divergence. She explained it like this: the East is pulling silver away faster than the West can suppress it. Shanghai prices continue to trade above COMEX. Physical demand from China, India, and the Middle East has stayed strong, even as paper speculators in the West are flushed out by margin hikes. That means silver is moving, not just in price, but in power. Pricing power is migrating east. And that shift isn't just a market story, it's a macroeconomic one. As the West continues to use paper derivatives to manage price optics, the East is building inventory, not in contracts, but in ounces. Central banks are buying gold, industrial buyers are front-running delivery risk, and individual savers are accumulating physical silver as a form of capital protection. That puts Western institutions in a difficult position. If they allow silver prices to rise naturally, it signals weakness in the dollar and raises questions about inflation, interest rates, and debt sustainability. But if they continue to suppress it through leverage-based futures, they risk a delivery crisis. He pointed out the imbalance. There are now hundreds of paper claims for every ounce of silver in COMEX registered vaults. That's not a market imbalance. That's a market on edge. And if even a small percentage of contract holders demand delivery, the system buckles. She believed the real danger wasn't just in delivery failure, it was in perception failure. Once market participants stop trusting the benchmark price, the pricing system loses its function. Silver becomes like energy in a war zone, not something you price, something you secure. That shift in mindset is already visible in retail behavior. In the US, major bullion dealers report back orders on 1,000 Oz COMEX bars. In Australia, certain silver coin products are sold out for months. In Europe, smaller private mints are now raising production to meet demand that used to be filled by centralized refiners. It's a decentralized scramble, one triggered not by hype, but by scarcity. And the deeper this fracture gets, the more asymmetric the outcome becomes, because paper positions can be settled in cash. But physical positions require metal. And in a structurally short market, metal becomes a weapon, a hedge, and a vault all in one. He summarized the situation bluntly. The silver market isn't just cracking wide open, it's splitting into two realities, one with ounces, one with promises. And only one of them will matter when this cycle ends. The East understands this. That's why they're paying premiums, waiting weeks, and bypassing Western pricing. They're not chasing price, they're securing availability. But in the West, many still wait for lower prices, unaware that price is no longer the final signal. Possession is. And if this fracture continues to grow, price discovery may never be the same again.